Hello there. Well, today I want to talk a little bit about interest rates, the housing market, the concerns of whether or not there's going to be a crash, and give a little insight into what we can expect here in the near future. So first up, anecdotally, out of the last 11 presidential elections, in 9 of them, we've seen an interest rate decrease somewhere between 0.3 and 0.5%. Now, that doesn't mean that just because it happened in the past, it's going to happen again, but 9 out of 10 is pretty good odds. And we've already started to see it, actually. Rates have started to come down. And, that's a big mystery about why interest rates would come down right before a presidential election, right? But again, if history is any indicator of all of the future, then we should continue to see interest rates decrease. Now, less anecdotally and more factually, what I can tell you that is an absolute truth, okay, without any argument from any economist anywhere, is that interest rates always follow inflation. And what you're looking at here on your screen is this is going back all the way to 1970, since we really started tracking this. So the blue line is the 30-year fixed rate mortgage, and the pink line is the rate of inflation. So that's the rate of inflation, okay? And what you'll notice is that there's just a slight lag between the rate of inflation and what mortgage rates do, okay? Now, these white bars that you see that are marked also by these red and yellow arrows, these are recessions. And the width of these white bars indicates the duration of the recession. Okay, so here we have the recession of 1972, then again 74, 1982, 1983, maybe that was 1981 actually, 1992, 2002, the Great Recession of 2008, and then the recession of 2020 when COVID hit. So some of the recessions were long, some of them were short, but it's very interesting to see what interest rates and inflation does in regards to these recessions. But the most important takeaway from this is that mortgage rates always follow inflation. And that's important. And it also makes sense. I'm going to blow this up here for you in a more easy to see magnified view. So this is the same chart, just without all the other stuff to confuse it. And this is just from January 2021 through June of this year, just a month and a half ago. All right. And again, the same holds true. So mortgage rates, which is in this case, the burgundy line, following inflation. And as you can see, here is where we hit the high point in October of 2023, just last year. And since then, we've seen the trending down as inflation continues to trend down. So as inflation trends down and as mortgage trends down, how will that affect the housing market besides the obvious? Well, first of all, with every 0.5% that we see in a decrease in mortgage rates, we're going to see millions of new buyers enter the market. So using 7% as a baseline rate, when rates hit 6.5, which they now have, that means approximately 2.8 million new qualified buyers can enter the market. So these are people that did not qualify for a loan before that now do. Then when rates drop to 6%, which we haven't quite gotten there yet, a total of about 5.4 million people will now qualify and can enter the market, and so on and so forth. So as interest rates continue to come down, you'll see. So every 0.5%, we see somewhere between, on average, roughly 2.5 million-ish people qualify and enter the market. What's very important to note about this chart is that this only takes into account new buyers that now qualify that previously didn't. This does not take into account all the people that currently do qualify that are choosing to sit out their purchase activity because they're waiting for things to improve. So as rates continue to come down, we're going to see a massive influx of buyers into the market. And you're going to see what that's going to do to the housing market. By the way, this comes from Jason Hartman, an excellent channel on YouTube. I will leave a link in the description so that you can follow him. I want to give credit where credit is due. He has excellent takes on the market, and I suggest you take a look. So, will there be a housing crash? Well, what is driving the housing market right now. Ever since COVID happened, as rates came down and the market took off, and we saw massive offers, dozens of offers on each listing, and offers over a list, and prices just going up and up and up. And we kept hearing that everybody's waiting for the housing market crash, which never came. And the reason for that is simple economics of the law of supply and demand. If you have a product and a lot of people want that product, but there's scarcity of that product is going to command a much higher price than in other circumstances. And housing is no different. And what we have had, and what we are going to continue to have for at a minimum the next 5 years, probably more closer to 10, is a housing crisis. We have a literal housing crisis in our country where there are more people that want homes than there are homes for people to get. So let me show you how that is demonstrated in actual numbers. So this is another chart. All of these charts, by the way, for the most part, come from the federal economic data centers. So the St. Louis Fred, as it's called. And so all of this is public information. So the orange line are household formation. So what is a household formation? A household formation is you have mom, dad, and a kid living in a house. The kid moves out. And so that's a new household formation. So where there was one household, now there are two. And it's literally that simple. So, and household formations come in a number of ways: kids moving out, people getting married, et cetera, and so forth. Okay. So, and this is going back a few years to the latter part of 2021. So this is about almost a 3-year look back. So what we see here are new household formations with the orange line. Okay. And then the blue line are housing units completed. So existing homes, short of some sort of catastrophe, the number of homes that already exist isn't going to change because they exist. So the only way to increase housing supply is to build new homes for people. And this blue line represents the number of housing units completed. And what you'll see is these red bars and these green bars, the red bars indicate a deficit. Okay. And the green bars, which are very, very few, indicates the time when there was a surplus, meaning we didn't have, just to take, for example, here in April of 2022, there were 1.9 million new household formations. Now, these are all annualized numbers. Okay. And at the time, there was only 1.1 million, or closer to 1.2 million housing units completed. In other words, we had about a 700,000 unit deficit of homes being completed for the demand at the time. And it's been that way for the most part all this time. Only on some very rare occasions did we see that there was calculated to be more homes than the demand. Now you might see right here, oh, well, the demand is going down because, we have these several green lines. Well, not actually. And there's a very strong reason for that. And I'm going to show you that now. So this is yet another chart from the St. Louis Fred, the Federal Reserve of Economic Data. And this goes back to 1980. Now, the burgundy line is inflation, or I'm sorry, is the cost of goods. Okay. The blue line is real income. And the green line is the rate of inflation. So you can see that sometimes inflation is higher or lower, but this is the actual rate of inflation. It bounces back and forth. But the red line is the actual cost of goods. So even though inflation now, this is where inflation hit a 40-year high. So in July of 2022, the rate of inflation hit a 40-year high. It hadn't been that high if you follow this dotted line all the way back until 1982. So 40 years hadn't been that high. But even though the rate of inflation is going down, the cost of goods is still going up. And there's a reason for that. And the primary reason is because the Federal Reserve has not yet lowered the Fed funds rate, which dictates all the costs of borrowing, from your credit card to your home equity lines to automobiles and everything else. So if businesses are still having to operate with high interest rates for buying their goods that they're selling and everything else, then they're going to continue to charge more and more for the product. So this is why there's conflicting information on the news, because you hear about how if you listen to some mainstream media news outlets, you will hear how they will say that people have more income than they've ever had before, that personal income is an all-time high. Well, that's actually true, as you can see from this blue line. And if you see this orange rectangular box, what's really important to note is that the spread between the rising cost of goods and the rising rate of real income, the spread between these two has been more or less consistently the same since going all the way back to the early 90s, maybe even before. Okay. It wasn't until right about here in January of 2021, okay, that we started to see this spread really increase. So even though people are consistently making more money, the cost, the actual price of goods continues to increase, and it's increasing at a rate that is faster than the rate of increase of people's real income. So that is why, even though inflation is going down, since the cost of goods is still going up, people are feeling it, which leads me to my next point, which is why when we saw on the previous chart why the rate of household formations was lower right now is because people have been expecting the Federal Reserve to cut the Fed funds rate to give relief to all of this, and they didn't do it. It was expected that they would do it at the beginning of the year, then April, and then in June, and none of that happened, and then July, and that didn't happen either. So what's happening is that household formations are down right now. And most interestingly, this is something called pent-up demand. This is from the U.S. Census apartment list, and the share of 25-year-old to 35-year-olds still living with their parents is this. So in 1940, 17% of 25 to 35-year-olds were living at home with their parents. And you can see all the various percentages over the different years, 1950, 1960, and so on and so forth. Okay. And right now in 2022, again, 17% of 25 to 35-year-olds are living at home. So when we finally get relief, when we finally see lower rates and the Federal Reserve starts to cut interest rates, then these people are also going to enter the market. So we have people qualifying for homes that didn't qualify before. We have people that currently qualify for homes that are choosing to sit out purchasing right now until things improve. And we have all this pent up demand from 25 to 35-year-olds living at home. So when everything it's going to be a perfect storm, and we are going to see a housing boom, the likes of which we haven't seen since probably 2021, early 2022. So how do we know that the Federal Reserve is going to lower rates? Well, this is done. This chart here is done by a company called the CME Group, and their whole thing is to watch what the Federal Reserve is going to do. I mean, they do other things, but they basically, for lack of a better description, take odds on what the Federal Reserve is going to do with the Fed funds rate. Now, remember, the Fed funds rate, which is the rate you always hear on the news about the government raising rates or is the government going to lower rates, they're not talking about mortgage rates. They're talking about the Fed funds rate. That is the basis for all of their lending in the country. And while there is no direct correlation between the Fed funds rate and mortgage rates, they certainly are connected because the Fed funds rate affects all other forms of borrowing and the expense of goods and inflation and things like that, which in turn, of course, affect mortgage rates. So right here, so currently the Fed funds rate is at 5.5%. Okay. And these are percentages of what's going to happen. So these are the Federal Reserve meetings that are coming up. We have one in September 18th, November 7th, December 18th, then starting in 2025, January, March, April, June, and July. So this is a look forward all the way through to of all the Federal Reserve meetings through July of next year. And what we can see is that at the next, we really had hoped that they were going to lower the Fed funds rate at the July 2024 meeting, the one that just happened a month ago. They didn't, which was foolish. And they are having some discussions of possibly an emergency lowering, but that's probably not going to happen. But what we do see is that 28% of the people believe that they'll lower the Fed funds rate about 0.25%. The other 3/4 believe they're going to lower 0.5%. And that's pretty like this look forward, this tool, this betting on what the Federal Reserve is going to do has been very reliable over the years. So we can pretty much count on that we're going to see 0.5% cut by the Federal Reserve of the Fed funds rate come the September 18th meeting. And what you see are the circles of the percentages of how much they're going to lower the Fed funds rate from now all the way through the end of July of next year. So what this is saying is if you look right here, 20%, 32%, 27%. So right here, if you add these up, it's a little over 80%. So by the end of July of 2025, there's over an 80% chance that the Fed funds rate will be somewhere between 3.25% and 3.75%. That means if the spread between the Fed funds rate, okay, and mortgage rates holds, that we should be able to expect to see the 30-year mortgage fixed mortgage rate somewhere around 5 to 5.25% by July of next year. And so that's how we can sort of predict in the future what's going to happen in terms of rates in the market. Okay, so here we have a chart of the number of mortgages currently in the country by interest rate. Okay, so below 2%, there's about 285,000 mortgages that are below 2%. Those are the really lucky people. 4.7 million mortgages are between 2 and 2.5%. 13.1 million are between 2.5 and 3. 11.3 million are between 3 and 3.5, and so on. What does this mean? In summary, 65% of the mortgages in the country are at 4% or lower, and 24% are at 3% or lower. Why is that important? That's important because that means that these people are probably not going to be refinancing or getting rid of these mortgages unless they have to for some external reason. Loss of a job transfer, death in the family, something that would be driving them to give up that low rate. What does that imply? That implies that is going to contribute to the problem of scarcity of housing. If we look right now where we are, so this is a recent snapshot from Redfin of the current housing market overview. The median sales price in the country is about 442,000. Okay, the days on market for any listing is about 32, which is very, very good. And the month's supply, in other words, how many homes do we have? How many months would it take to exhaust all the homes? Well, we only have a 3-month supply. What does that mean? That means that this is according to the National Association of Realtors, that when you have a housing supply of 7 months or more, it is a buyer's market, meaning buyers can go in, negotiate strongly, and sellers really have to capitulate and give into a lot of those demands. Okay, a neutral market is somewhere around 6 or 7 months, and a seller's market, which is what we are currently in, is when there is less than a 6 months supply of housing. Again, so the law of supply and demand. So there's a scarcity of our product. There's only 3 months supply. That's why sellers are having still multiple offers over list, and the housing market has been and continues to be strong. So if it's this strong right now, when rates are as high as they've been, remember, we've got rates coming down. We've got about 2.5 or so million new qualified buyers entering the market with each 0.5% of rate improvement. We have a whole bunch of other buyers that are currently qualified but are choosing to sit out the market until rates come down. And then we have all the pent-up demand from the 25 to 35-year-olds that are living at home with their parents. These things are going to combine to create a housing boom. As I said, that is why the market is strong. There will be no crash. And we should see a very, very active and fun market here over the next 10 to 12 months. If you have any questions, please feel free to reach out to me anytime. I'm always happy to talk and address any questions or concerns. Otherwise, have a wonderful day, and we'll talk with you soon. Take care.